Hello guys, my name is Siddesh Parekh from the Money in Minutes. The group member are Shubham Kadi, Ayush Jain, Ayush Kora and Shreyans Jain. We are going to present you the book which are You Can Be a Stock Market Genius by John Greenblatt, and later we will update you high frequency indicators and themes. So let's start with a brief information about the author. John Greenblatt is a renowned American value investor, hedge fund and profession. He founded a Gotham Capital where he delivered exceptional return over a year, and later he taught value investing at Columbia's Business School. Greenbelt is best known for popularizing the disciplined, logic-driven investing framework. Most famously, Magic Formula, the focus on buying a good business at a cheap price. He is the author of You Can Be a Stock Market Genius, where he explained how individual investor can find a high return opportunity in a special situation like spin-off, restructuring, mergers and acquisition. Often area where large institution investor are ignore the areas like introduction to a book. You Can Be a Stock Market Genius. It is not a typical how to pick a stock book. John Greenberg core message is very simple but very powerful. You can beat the market. You can beat the market by being a smart than everyone. You can beat the market by playing a different game. The big idea of the book is the most investor and professional compete the crowded area like large cap stocks, well researched companies, high forecasting companies, have popular narratives, right? John Greenblatt says don't fight there, you will lose. Instead he teach you, you have to look at corporate situation, not just companies. Corporate situation like spin-off, mergers and acquisitions, bankruptcy, restructuring, and right issues. Right, there are temporary. These are the temporary situation where institutions are forced to sell. Analysts stop covering the stocks, and complexity scares most of the investor. Price disconnect from the value. This create a misprice for a this create a misprice this create a misprice which is real source of abnormal return. Let's start with diversification concentration. John Greenberg explained the diversification and concentration address different kind of risk and confusing the two is the main reason most investors earn only average return. He divides risks into two categories: market risks and non-market risks. Market risks such as interest rate hike or market crash cannot be eliminated by a diversification. For example, if a stock fall from 30%, a portfolio of 5 stock, 50 stock, or even a 500 stock still can decline significantly. Diversification does not protect investors from this type of risk. Non-market risks, however areas from arise from company specific problems such as frauds, poor management decision, or operational failures. This can be reduced to a diversification, but not only up to a point. Greenman shows that most of the benefit of diversification is achieved very quickly. For instance, for moving from one stock to two stock, nearly half of the company specific risks, while holding around 6 to 8 stock, remove the majority of it. Beyond the level, the reduction in risk is minimum, but the impact on return become a substantially, right? Suppose investor have a 10 lakh rupees, and a stock has been doubled from 100 rupees to 200 rupees. If an investor owns only 5 stock and equal weighted, the winning stock represents only 20% from the overall capital, right? From the overall of the portfolio, and adds roughly 20% of the portfolio value. If a same investor hold 25% stock, it will drop to 4%. Professional investors don't often hold 500. Professional investors need to hold 550 to 200 stock, not because it is optimal, but because they are forced to buy it. Because for example, a fund manager managing a 1 lakh crore investing 500 crore in a small cap, worth only 10,000 crore without breaching ownership of a liquidity, without breaching a liquidity limits, right? Greenbelt argues the concentration makes sense when an investor has done deep research and downside risk is limited. A concentrated portfolio of 5 to 8 well understood stock can be less risky than diversified stock of 30 poorly understood stock, right? He also emphasized the cash is a superior risk management tool compared to adding a low convincing stock. For example, investing a 10 lakh rupees high confidence stock and keeping a 4 lakh rupees in a cash often safer and most effectively than spreading 10 lakh rupees across a 20 Medicare stock, right? In essence, Greenbelt core messages is that diversification protect investor from ignorance while concentration reward knowledge. Now, Shubham Kadi will explain you further.
Hello everyone, I am Shubham Kadi and today I'll be talking about spin-offs. So what exactly is a spin-off? A spin-off is a situation where a corporation takes a subsidiary, division or part of its business and separates it from the parent company by creating a new independent freestanding company. For example, company A has two business verticals earning a PAT of 100 crores and a PAT of 2 crores. Now, company A decides to spin off its segment that owns a part of 2 crores. There will be two separate business entities, standalone company A and spin-off company B. How has spin-offs actually performed? According to a study covering 25 years ending 1988, that found out that stocks of spin-off companies outperformed the S&P 500 by about 10% within the first 3 years of independence. That means if the S&P 500 gave you a total return of 18%, the spin-off companies gave a total return of 28%. But why do spin-offs actually happen? The first reason is clarity. Now, unrelated businesses may be separated by a spin-off transaction so that the separate business can be better appreciated by the market. Suppose there is a corporation ABC with a steel business and an insurance business. Now, the steel business earns a PAT of 100 crores with a good PAT margin of 7%. The insurance business earns a PAT of just 5 crores but not such a great PAT margin of 2%. People are majorly interested in the steel business, but they refrain from buying the corporation ABC shares because of the insurance business as well. If ABC decides to separate its insurance business, the investors will be happy that they can now own the shares of the steel business only. The second reason is focus. It is possible that the management of the corporation has to put undue time and effort on the bad business, which is why they can't go all in the good business. With the separation of the bad business, there can be two separate management groups for the individual entities, which will help each of them focus and allocate time more effectively. The third reason is financial engineering, and I'll explain this with the help of Excel. Now, let's say there's a parent ABC which has two verticals, vertical A and B. Vertical A has a PAT of 100 crores and a debt of 100 crores as well. Vertical B has a PAT of 5 crores, whereas a debt of 500 crores. This gives the total PAT for ABC at 105 crores and the total debt at 600 crores. Because of this high debt, the market does not assign a high PE multiple and it gives just a multiple of 10, giving a market cap of 1050 crores. Now, parent ABC decides to spin off its vertical B. So, and also decides to shift all of its debt into vertical B. So, vertical B will have a total debt of 600 crores now. Vertical A becomes debt free. Now, for simpler calculations, I haven't included the interest in the PAT of vertical A. However, the PAT will actually increase because it saves on the interest expenses that it used to pay in the debt. Now, because vertical A is debt free, the market assigns a P of 20, giving it a PAT of 2000 crores. Whereas because the debt in vertical B increased, the market assigns a value P of just 3, giving a market cap of 15 crores. Now the combined market cap becomes 2015 crores. This indicates a huge increase in the value for shareholders as the market cap almost doubled. As you can see, first it was 1050 crores, now it's 2015 crores. The fourth reason for a spin-off to happen is tax efficiency. Now, I'll again explain this with the help of Excel. Now, suppose a business acquired another business years ago at a cost of 10 crores. Currently, the value of the business is 100 crores. Now, if if the parent company decides to sell its business, it makes a profit of 90 crores on sale. Now it has to also pay a tax of 30%, giving an after tax profit of 63 crores. Now the company decides to distribute the proceeds that it received as dividends. Now the shareholders also need to pay a tax on this at 30%. The final amount that the shareholders receive is 44.1 crores, which is less than half the value of the profit that the company made on sale. This is a clear cut case of double taxation, indicating that the same amount is actually taxed twice. Now we'll go into a case study that was mentioned in the book, the case study of Marriott International. Now, during the 1980s, Marriott Corporation had aggressively expanded its empire. It had two businesses under them: building, owning, and selling hotels, and managing hotels and charging a management fee for them. The first business was burdened with billions in debt and a load of unsaleable hotels. The second business was the cream of the corporation. It had a huge income stream and very little assets, resulting in high turnovers. During the 1980s, the real estate market was actually in a down cycle, and Marriott Corporation was stuck with a lot of debt and hotels. Then entered Stephen Bolenbach, a person with a history of successful financial turnarounds. He became the CFO of Marriott International. He decided to leave all the unsaleable hotels, high debt, and low growth concession business all in one company, that is Host Marriott or the Bad Marriott. He decided to spin off the highly desirable management service business, which had almost no debt, into a company called Marriott International. The terms of the trade were as follows: Stephen Bolenbach would become the CEO of Host Marriott, which is the Bad Marriott. Marriott International, the Good Marriott, would extend a loan of $600 million to help with the liquidity needs of Host Marriott. The Marriott family, which owned 25% of Marriott Corporation, would own 25% stake in both the hotels, Host Marriott and, sorry, both the companies, Host Marriott and Marriott International. The spin-off would take place in the middle of 1993. The author, that is Joel Greenblatt, was interested in the Host Marriott business, which is the Bad Marriott business, because it showed a number of characteristics. The first one was that institutions did not want it. The fact that Host Marriott looked so awful at first glance and so unpopular because which is why most institutions would be discouraged from doing any further research on it. Another reason would be its size. Host Marriott only accounted for 10 to 15% of the total value being distributed to the shareholders, with the remaining going to Marriott International, the Good Marriott. With Marriott Corporation's market cap being around $2 billion, the market cap of the Bad Marriott was going to be only a fraction of this. Even if a pension or a mutual fund took the time to analyze the company further, Host Marriott would be too small for an institutional portfolio, which contains only large cap companies. Now, the second reason is that majority of the shareholders did not buy Marriott Corporation for the Host Marriott business. Most investors were attracted to the Marriott International business when they bought Marriott. So whenever they got the stock of Host Marriott, they were just going to sell it. The third reason is insiders want it. One of the key areas to look for is insider participation. In the case of Marriott, the key person, that is Stephen Bolenbach, was going to be the CEO of Host Marriott. And the Marriott family was also going to hold 25% stake in Host after the spin-off. The fourth reason was a hidden opportunity existed in this. Let me explain this with the help of an example using Excel. Now, the equity value per share of the Host Marriott business, as is the Bad Marriott business, was $5. And the debt it carried was around $25 per share. This gave a total asset value per share of $30. Now, let's take two scenarios where the real estate prices or the asset prices increase by 15% in value. This would give a total asset value per share of $34.5. The debt value per share would remain the same at $25, and the equity value per share would increase to $9.5 because of this, giving an increase of almost 90% per share. However, there can also be a down cycle. Suppose assets fall in value of 15%, giving the total asset value of $25.5. The debt value again remains the same at $25 per share, giving an equity value per share of $0.5, giving a downfall of about 90%. Now, the author now the author actually thought that the bad things about Host Marriott was actually stretched too far, and the assets were not as bad as they were shown to be. The result, the result was that Host Marriott, the bad company, nearly tripled in value within 4 months after the spin-off. The next example I'm going to show you is of Strategic Security and Briggs and Stratton. In 1994, Briggs and Stratton, who was the manufacturer of small gas powered engines, announced its intention to spin off its automotive lock division. This division, later to be known as Strategic Security, represented about 10% of Briggs and Stratton's total sales. The main business of Briggs was to make and sell small engines, and the parent had a market cap of $1 billion. This would make Strategic Security a market cap of $100,000, a size which is inappropriate for most of Briggs and Stratton's institutional shareholders. This would make it a prime candidate for institutional selling, as we discussed previously. One of the first moves of the author is to check what the management and controlling shareholders are up to. In case of Briggs and Stratton's, it was pretty clear. One of the reasons for the distribution is to provide compensation to its key employees, that is equity based and tied to the value of Stratec. So if the value of Stratec goes up, so does the compensation, giving them a direct incentive for this. Along with checking for this, Joel Greenberg also checks the first few pages of Form 10, which is the document or proxy statement that is released to the public during a spin-off. According to the pro forma income statement, earnings of Stratec for fiscal year ending 1994, June 1994 came in at $1.18 per share. It was also expected that earnings would increase for about 10% for the first half of the year ended 1994 as compared to the same period ending 1993. Since Static was an auto parts company, the author figured to give it a P of between 9 and 13 as a fair P. Now, the reason for this is because roughly the other auto parts companies traded at a P of 10. So, using a range of 9 and 13, a reasonable range for Static Security stock price was between $10.62 and $15.34. However, after reading the document further, the author discovered that Static was by far the largest supplier of locks to General Motors, which represented about 50% of Static sales, and also provided all of Chrysler's locks, which represented about 16% of Static sales. Furthermore, Static believed that Ford would become the second largest customer during FY 1996. This meant that the Ford's revenues would be between 16% and 15%, 50% of General Motors. Supplying to these clients also meant one more thing, that the quality and price of Static's products must be way ahead of the competition. The author had intention of buying the shares in the lower range of the PE. And for several months after the stock began trading, it was between 10 and 12 PE, clearly indicating that the low end of the business was this without taking into consideration three important factors. That is the Ford business, Static's far better market niche, and the recent 10% increase in profit during the recent 6 months ending 1994. What was the result? The result was that Static jumped to $18 per share before 1995, giving it a 50% gain within less than 8 months. That's all from my end. Thank you.
So now we will talk about bankruptcy. Bankruptcy rarely sounds like an investment opportunity, but it can be one. Companies don't end up in bankruptcy only because the business is bad. Many get there due to mismanagement, overexpansions, regulations, lawsuits, or very often because excessive debt was taken with optimist projections overwhelms that otherwise a good business. That said, buying the common stock of a company in bankruptcy is usually a bad idea. Equity holders sit at the bottom of totem table. They get paid last after employees, banks, bondholders, suppliers, and the IRS. Even when a company survives bankruptcy, pre-bankruptcy shareholders are typically wiped out or left with token stake. Yet, these stocks often trade at unjustified prices due to speculation. As a result, equity during bankruptcy is rarely profitable. The real opportunity lies between equity in the capital structure. Bonds of bankrupt companies often trade at 20 to 30% of face value. If recovery is better than expected, a bond bought at 30 cents may recover 60 to 80 cents, generating large gains. Bank debt is another area. Buying defaulted loans, bank at deep discounts and profiting when higher recovery is achieved because banks rank high in the bankruptcy repayment order. Defaulted loan is often purchased at a fraction of original value, sit higher in priority, and can offer attractive recoveries. Then there are trade claims. Purchasing unpaid suppliers, invoices at discount prices, and earnings returns when bankruptcy settlements pay more than the purchase cost. When unpaid suppliers sell claims at discount, allowing investors to profit if settlements exceeds purchase prices. However, this is not a casual investing. Bankruptcy involves complex legal negotiations, uncertain timings, and limited information. Even professionals like vulture investors rely heavily on experience. Unless this is a full time focus, the risk usually overweights the rewards. The real opportunity appears after bankruptcy since most companies lack cash. Debt holders are paid with new bonds or new equity, making former creditors the new shareholders, while old shareholders are largely wiped out. Before trading begins, investors can study the statement which explains the bankruptcy processes and includes management's future projections. Here's where mispricing comes in. Banks, bondholders, and suppliers never wanted equity, so they often sell immediately. This forced selling creates temporary mispricing, but you must pick your spots. Random buying does not mean that it will work in your favor because many bankruptcy companies remain in weak industries or lack capital. That said, a 1996 study found that stock emerging from bankruptcy between 1980 and 1993 outperformed the market by over 20% in the first 200 days, mainly among small and low market cap stocks. Mispricing persists because Wall Street ignores the orphan equities. There are no fees, no research, no roadshows, or no commissions. To separate real bargains from traps, the author follows Buffett's logic. Stick to good businesses. The best candidates are companies bankrupted due to excess leverage from leverage buyouts or acquisitions, not poor operations. Fix the debt and equity upside can be dramatic. Other valid cases includes settling product liability claims or shading loss-making divisions. A perfect example is Charter Medical. In December 1992, the stock traded at just over $7, where the peers were trading at values near $15. Debt was cut from $1.6 billion to $900 million. Insiders had the skin in the game. Operations were stabilizing and free cash flow was estimated at 2.5 to $3 per share. As costs were controlled, assets were sold, and Wall Street's attention returned, the stock tripled, validating the orphan equity thesis. Focus on a small set of bankrupt companies that are still good businesses, ignored by Wall Street and temporary misprice, and be selective. Now comes the selling part. Selling is harder than buying. Buying makes sense. You buy when it's cheap, when it's ignored, and when a special event gives you an edge. Selling has no fixed rule. The key insight is this: extraordinary situations have a time limit. Spin off, merger, post bankruptcy stocks all are mispriced because of a specific event. Once the market understands the change, your edge fades. That can take weeks, months, or a few years, but it does not last forever. You sell when the prices has moved meaningfully or when fundamentals disappoint. The author's rule is simple. Trade the bad ones, invest in the good ones. If the business is average and the gain comes from mainly from neglect, like Charter Medical, sell once the stock is discovered. But if the business is strong, like American Express, you can hold it. Let me tell you, why I am pointing American Express as a strong business. The spin-off of Lehman Brothers temporarily hid the strength of American Express's core business, allowing it to trade at just the multiple of 9 to earnings. Once earning grew and the market re-rated the business, returns came not just from the event, but from the owning a high quality company long term. Part of the return comes from the event. The rest comes from the business's performance. The event gets you in. The business decides how long you stay. Now let's move on to corporate restructuring. Corporate restructuring is another area where extraordinary corporate changes often happen under pressure, can create meaningful investment opportunities. When we talk about restructuring here, we are not referring to small operational tweaks or cost cutting exercises. We are talking about big, decisive actions such as the sale of shutdown of an entire division. Importantly, the division must be material to the size of the company. What do I mean by material? Meaning it is large enough to meaningfully impact earnings, cash flows, and valuations. Selling or closing such a division actually changes how the company looks financially. Minor businesses don't move the needle and therefore don't unlock value. Corporate restructuring happen all the time. They are a painful but necessary part of capitalism. Capitalism does not reward inefficiency forever. Restructuring is the mechanism through which weak or loss making businesses are removed and capital is redirected to stronger and more powerful uses. Without restructuring, poor divisions would continue destroying value and drag down the otherwise healthy companies. From an investor's perspective, the most attractive restructuring situations are those where companies sell or close major loss making divisions in order to stop losses, reduce debt, or focus on more promising lines of businesses. The reason these situations can be so attractive is that very often the division being sold or liquidated has actually been hiding the true value of the company's remaining businesses. Consider a simple example. Imagine a conglomerate earning $2 per share, trading at 13 times its earning, or we can say at the stock price of $26. On the surface, this looks fairly valued. But suppose there were two profitable divisions earning $3 per share, with a third division is losing $1 per share. That loss making division depresses both earnings and valuation. If it is sold or shut down without creating the liabilities, earnings immediately rise to $3 per share at the same 26 price. The valuation drops from 13x earnings to less than 9x, instantly revealing value that was already there. In many cases, selling a loss making division can also result in positive net cash proceeds, which further strengthen the balance sheet and enhances shareholder value. Restructuring creates a more focused enterprise management can concentrate on few stronger operations, and the market is often willing to assign a higher valuation multiple to companies that are simpler, more specialized, and consistently profitable. Though it may seem counterintuitive because restructurings often follow businesses' failures. Companies that pursue major restructurings are often highly shareholder oriented. This means management is willing to make difficult and sometimes unpopular decisions, such as selling a large division, not to protect ego or size, but to improve long-term shareholder returns. Unless a company is in extreme distress, choosing to sell a major division is hard, and management who do so usually have shareholders' interest firmly in mind. There are two ways for investors that can benefit from capital corporate restructuring. The first is to invest after a restructuring has been announced. Even after the announcement, there is often ample opportunity because the market takes time to fully understand the financial and strategic impact of such a significant move. This opportunity tends to be greater in smaller companies where very few analysts and institutions are tracking the stock, allowing mispricing to persist a bit longer. The second approach is investing in companies that are ripe for restructuring. This is much more difficult. Ripe for restructuring means the company clearly has a large division that is destroying value, dragging down valuations, or stressing the balance sheet, and restructuring would make obvious economic sense. Even though management has not yet announced anything, this approach is difficult because you are investing before the decision is visible. There is no announcement, no timeline, and no clarity that management will act. The stock may remain cheap for you, or management may never restructure at all. You are betting on what should happen, not what has happened. That's why author does not actively seek out these situations. However, he emphasizes the importance of being able to recognize one when it appears. Often, if the need of restructuring is obvious to an investors or management, especially those with significant equity ownership, is already thinking along the same time. And sometimes you don't need to hunt for the opportunities at all, they simply fall into your lap. Let's look into the case study of Greenman Brothers. Greenman Brothers illustrates how weak divisions can hide a much better business inside the other company. At that time, Greenman was a marginally profitable wholesale distributor supplying over 7,000 retail stores. The business earned very little, despite making the company appear dull. As a result, the stock traded just over 5 per share, a book value exceeding $8 per share. Let me explain a book value for you. Book value represents what shareholders would theoretically receive if all assets were sold and liabilities paid. In Greenman's case, most assets were cash, receivables, and inventory that could realistically be sold. The key insight was this: the weak distribution business was making a high potential retail concept that was known as noodle ki doodle. Early stores showed strong customer demand, and management had discovered plans for aggressive expansion if results continued. At prices below $6, the market was assigning virtually no value to Noodle Ki Doodle, even if Greenman sold its distribution business at 25 to 40% discounts to book value. Proceeding would still be around $6 per share. Here's the math. Book value was roughly $8 per share. A 25 haircut assumes only 75% recovery. That is $6. Even a harder 40% haircut yields about $4.80. That means the stock price was largely justified by asset value alone. This is why retail concept was effectively free. Why free? At prices below $6 per share, investors were fully paying for existing assets. No additional value was being assigned to Noodle Ki Doodle. Even if the retail idea failed, completely assets value protected the downside. Any success becomes pure upside. This created a classic margin of safety. For over a year, the stock traded at $4 to $7, while the retail businesses grew to 20 stores. Meanwhile, the distribution business deteriorated, increasing pressure on management. The catalyst arrived in May 1995 when Greenman announced it was exploring a sale of its distribution division to fund retail expansion. Instantly, the company was redefined from a slow distributor to a growth retailer. The revaluation was swift. The stock moved from $6 to $11 within 2 months and reached $14 within 4 months. This was not driven by earnings growth, it was driven by structure. The market finally sees the value that has already been there. The author exited between $10 to $11 and the restructuring unlocked value. The story was out and the margin of safety had narrowed. Restructuring did not create the value, it revealed had been hidden. I conclude. We begin with risk arbitrage, one of the most misunderstood strategies in investing. At its core, risk arbitrage is about buying the shares of a company after a merger is announced, but before it is completed, hoping to earn the difference between the current market price and the acquisition price, the so called spread. This sounds simple, but the spread exists only because risk exists. There are fundamental risks that define risk arbitrage. First, the deal risk. Mergers fail more often than people assume due to regulators, financing problem, shareholder resistance, or surprises uncovered during due diligence. When a deal collapses, the stock does not drift down, it falls sharply, often to levels where below the arbitrator entered. Second, time risk. Deals almost always take longer than expected. Even if the transaction eventually closes, delay crush annualized returns and lock capital in dead money. Today, Risk arbitrage is dominated by hedge funds, proprietary desks, and algorithm traders. Their presence compresses spreads to razor thin levels. The result is a dangerous equation. Low return potential combined with binary downside risk. The Florida Cypress Gardens Harcourt Brace case demonstrates this perfectly. Everything looked favorable, reasonable pricing, cooperative shareholders, a clear buyer. Yet an unforeseen operational issue derailed timeline and confidence. The delay eventually closed, but returns were negligible, reinforcing the reality that even successful arbitrage can be unprofitable. The combined international Ryan insurance deal shows another weakness fragility. One expected veto almost killed the transaction overnight. This is the nature of risk arbitrage. Outcomes can flip instantly with no margin for error. The conclusion of risk arbitrage is unambiguous. For individual investors, risk arbitrage offer poor risk reward, high uncertainty, and no structural edge. Now we'll move forward to merger securities. Now contrast with the merger securities where real opportunity exists. Merger securities arise when acquisitions are structured using instruments beyond plain cash or equity. This can include convertible debt, preferred shares, warrants, contingent value rights. Most investors ignore these securities. Institutions often can't hold them. Analysts rarely cover them. Portfolio managers don't want complexity. That neglect creates systematic mispricing. Unlike risk arbitrage, merger securities are not about betting on delay closure alone. They are about understanding structure, payoff mechanics, and downside protection. The super right foods leveraged buyout illustrates this clearly. As bidding intensified, the deal structures evolved, issuing securities that mainly investors dismissed as non-core. Those who analyzed the cash flows, conversion terms, and embedded optionality earned substantial returns, not because the deal closed, but because the securities were misvalued. The Paramount Viacom battle is an even stronger example. The headline price grabbed attention, but the real value lay in the fine print, CVRs, warrants, and convertible embedded in the transaction. Investors who understood these instruments extracted returns for superior to plain equity holders. The key distinction here is critical. Risk arbitrage depends on event outcome. Merger securities depend on valuation and structure. And structure is where individuals still have an edge. This strategy rewards patience, mathematical discipline, willingness to read what other ignore. So arbitrage is a no, but merger security is a yes.
So now moving on to the economic themes. The first theme is the effects of repo and CRR cuts and why they matter to the economy. To begin with, the repo rate is basically the interest rate at which banks borrow short-term money from the RBI. So when the repo rate is lowered, banks can borrow more cheaply, and that directly flows into the economy in the forms of lower loan rates. Home loans get cheaper, business loans become more affordable, and personal loans come down. This encourages both consumer and companies to borrow more, which increases spending and investment. Next comes the CRR or the cash reserve ratio. This is the percentage of deposits that banks have to keep with the RBI and cannot use for lending. When the CRR is cut, banks instantly have more funds available. Think of it as a liquidity injection. Suddenly, there's more money circulating in the system. CRR cuts boost the ability of the banks to lend, while repo cuts reduce the cost of lending. When both happen together, they create a very supportive credit environment. In the short term, the RBI has to be more cautious. If credit grows too fast or too cheaply, it can push the inflation up. And when inflation rises, the central bank might have to reverse the cuts and tighten rates again. Right now, the repo rate stands at 5.25%, the CRR at 3%, and the GDP growth at 8.2%. India is in a phase where liquidity is strong and borrowing is relatively affordable. The next economic theme are Trump tariffs. A lot has happened in the last 1 year, and each step had a different impact on India. Everything began on 2nd April 2025 when the US announced its reciprocal tariff regime. This basically meant If another country charges high tariffs on the US will match it. A baseline of 10% tariffs was put on most imports, but for India, the effective rate worked out to be around 25%. So India immediately became one of the most affected countries. By early July 2025, the US extended a pause on the rollout. This was essentially done. This was essentially a negotiating window, and it temporarily delayed the harsh measures because of discussions were still ongoing. Then the big moment came on 30th July, stretching into the first week of August. The Trump administration formally announced a 25% reciprocal tariff specifically targeting India. This time the coverage was broad, textiles, gems, and jewelry were some of the categories that were hit by the hardest. Just a few days later, between August 6th and 27th, things escalated even further. The US added another 25% penalty, but this one was tied directly to India's Russian oil purchases. If fully applied, the total tariff impact could reach around 50%. During this phase, gems and jewelries and textiles were hurt the most, along with selective auto parts and furniture. But there was relief too. Early August to September, the US clarified that pharma, electronics, and smartphones would be exempt. This was significant because India is a major exporter of generics and also growing electronics manufacturing hub. Then, in mid-November, from the 16th to the 18th, we saw a first signs of easing. Some agricultural tariffs were rolled back, giving exemptions to tea, coffee, spices, cashews, and few tropical fruits. Finally, by December 2025, the situation shifted into a more diplomatic phase. Senior US trade officials visited India, signaling that negotiations were still active and the overall status was continuing to evolve. Thank you.
Now let's look at our portfolio. Where when our portfolio, why our portfolio is red when Nifty is at an all-time high, or Nifty at its peak? Because no one is seeing the market. No one is seeing the market is underrated, right? An index tell you the headline, but the market bread will tell you the actual story. Let's first understand what is the market breadth actually means. You cannot look at the Nifty and assume that the whole market is rising. You must break the market into a three parts: a large cap, mid cap, and small cap, or even in a micro cap also. And then you should ask one question in each segment: how many stocks are rising and how many stocks are falling. This count is called a market breadth. If you look at a current scenario, look at the fall from 52-week high. Large cap stocks, which are more than 50,000 crore, 58% of large cap stocks are down by 10%. And if you look at the mid cap, 48% of stock are down by 28%. And when we look at the small cap, almost 40% are down. Almost half of the segment is down from the 40%. Now your portfolio lives in this company, not in the Nifty 50. When half of the broader market is seeing a drop, you cannot use Nifty to judge a market is doing well, because Nifty is not a market. Nifty, it is a concentrated portfolio of top five companies hold 30 to 40%, like HDFC Bank, Reliance, ICICI Bank weightage, right? Only this company can lift the index, while the thousands of smaller companies can actually down. Now look at the adjusting investor acceptation from a new market cycle. Investor behavior has shifted over a time. That how major event like global financial crisis, COVID has changed how people think about the market, from fear driven to overconfidence in equity return. Acceptation versus reality. Many investors today assume a high double digit return, 20% return, and easy or guarantee. But historical, even a legendary investor hasn't sustain that over a period. Market cycle has changed over post 2008. Big boom and bust swings are become a big boom and bust swings are there. Okay, now become a now it's become a small. Okay, meaning the market may spend more time in a corrective or sideways phase, making extended low return period. A drawdown on rolling return might matter when there are a long stretch where the 3 to 10 year rolling return can be single digit or even a negative. So return are not a linear or guarantee.
I will briefly cover the latest developments in India's PLI schemes and what they mean from a manufacturing and investment perspective. First one is smartphone PLI, India's manufacturing proof point. Under the smartphone PLI scheme, Apple crossed $50 billion in iPhone exports from India by December 2025, achieved in just 4 years. India is now the only country outside China where iPhones are manufactured and scaled. Smartphone accounts for 75% of India's mobile exports and have become the country's top export item. While the smartphone PLI ends in March 2026, government will support the by continuing through new incentive frameworks. The key takeaway is the supplier ecosystem. Companies like Tata Electronics, Foxconn, Motherson, Hincalco, and ATL are positioned to drive the next phase of electronic manufacturing value addition and employment growth. Electronic components. Motherson Electronic Components have been approved under the Electronics Components Manufacturing Scheme, that is ECMS, with 1,900 crores rupees investment planned between FY26 and FY31 and 5,000 plus jobs expected in Tamil Nadu. This marks a shift from final assembly to component level manufacturing, which is critical for improving margins, reducing imports, and building long term competitiveness in electronics. Third one is textile PLI. Policy course correction. The textile PLI scheme has been extended till March 31, 2026, with lower investments threshold, reduced turnover requirement, and expanded product coverage, especially in MMF and technical textiles. As of October 2025, 74 companies are approved, 287 billion rupees in investments committed, and 2.6 lakh jobs are expected. The focus here is on higher value, export oriented textile segment, not just volume growth. Overall, PLI is evolving from a subsidy driven program into a strategic capital allocation tool. Smartphone shows scale, ECMS builds depth, and textile ensures diversification. Together they position India for manufacturing export driven growth over the next decade. Now, I will talk about India's services PMI. India's services PMI has remained consistent in expansion over the last 2.5 years. In 2023, PMI stayed above 60, indicating strong post pandemic demand and rapid services growth. During 2024, the momentum remained healthy, with PMI largely in the high 50s to low 60s range, reflecting stable expansion across IT, financial services, travel, and hospitality. In 2025, the PMI gradually normalizes to around 58 to 59, ending December 2025 at 58. This moderation reflects slower global demand and cost pressures, not a contraction. Overall, the key takeaway is that India's services sector remains resilient, with growth moderating from peak levels but staying firmly in expansion territory.
Now let's look at the automobile production. November shows strong rebound of to 22.3%, indicating normalized after October concentrate and improve dispatch momentum. Passenger vehicle production, you can see that output has rose 22.8% year on year, reflecting a sustained demand and ease supply side concentrate. Right. Tractor production, as we can see that tractor volume has surged 37.5%, reinforcing continued strength in rural demand and agri-led income support. Two-wheeler production, you can see that growth recovery sharply to 20.9%, suggesting early sign of revival in mass market affordable lead demand. Three-wheeler production output jumped 55.4%, highlighting strong transaction in mobility service, logistic, and informal sector activities.